Hey everyone, welcome back to Corporate Decoder. Today we are diving into Pulmonx Corporation, ticker symbol LING, and their latest financial report. It's full of interesting details. Will they finally get some air under their wings, or will they be left gasping for breath? Stay tuned to find out. Before we get started, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where you can discuss these reports with other finance enthusiasts and compare notes. Now let's start decoding. This is their Form 10Q, which is a quarterly report that public companies must file with the SEC. It gives investors an update on how the company is doing financially. This one covers the period ending in March of 2025. First, let's take a look at the important numbers. Pulmonx ended March with about $74.6 million in cash and cash equivalents. That's up from the $70.9 million cash and cash equivalents. That's up from the $70.9 million cash and cash equivalents. That's up from the $70.90 Now, for the not so great news, their net loss, which is the amount of money they lost, was $14.4 million for the quarter. That is compared to a loss of $13.7 million for the same period last year. So their losses are growing, but hey, it could be worse. Their revenue, or the amount of money they brought in from sales, was $22.5 million. That's a rise from the $18.99 in the same quarter of the previous year. So sales are up, but so are losses. Breaking down the losses per share, it's about 36 cents per share. That's the same as last year, so at least that number isn't growing. There's an important section of their financial report where they talk about whether the company can continue as a going concern. This means whether the company can continue operating for the next 12 months. They say that they believe their current cash and investments are enough to keep them going for at least the next year. That's reassuring, but it's something to keep an eye on. They need to estimate how much of their accounts receivable, which is the money owed to them, might not get paid. As of March, they didn't anticipate much lost revenue because of unpaid bills. Let's dive deeper into the numbers. Looking at their assets, besides cash, they also have short-term marketable securities, which are like investments that they can easily turn into cash, worth $14.1 million. Their inventory, which is the products they have ready to sell, is about $16.8 million. On the other side of the balance sheet, their total liabilities or debts, about $73 million. Their total stockholders' equity, which is the value of the company owned by the shareholders, is about $77.7 million. Let's break down where their revenue is coming from. The United States is their biggest market, bringing in $14.22 million in revenue. Europe, the Middle East, and Africa, which they call EM, brought in about $5.5 million. Asia Pacific, which includes places like China and Japan, brought in about $2.8 million. They mentioned that one customer accounted for 10% of their revenue, which isn't ideal because the company might be dependent on it. Now, about that debt. They have a loan with CIBC, a Canadian bank. The total value of it is $37 million, but that is reduced when accounting for debt issuance costs to around $36.9 million. The company rents many buildings. They paid $808,000 in rent during this quarter, on top of other lease expenses. They pay their employees partially with the company's stock. This quarter, it was $5.6 million which they paid out. Finally, this is a legal formality to ensure that there are no hidden deals or activity by the company's leadership. The report states that none of their directors or officers engaged in any special trading arrangements. And now the fun part, what are some of the risks mentioned in the report? A main one is that they currently rely on a single product, the Zephyr valve, and if they're not successful at selling it, they are in trouble. What if hospitals, physicians, or patients don't accept their solution? They will lose money. And because implanting the Zephyr valve involves risks, including some very serious complications that may further scare people off, ALU reimbursement is also a big issue. If insurance companies don't cover the cost of their solution, sales could suffer. Competition is also a huge risk, as it always is in the medical device industry. There is a risk in US-China trade relationship. If China puts up trade barriers, then they will also lose revenue. Additionally, they state cybersecurity, inflation, or other natural disasters could negatively affect their business. I'll take a look at what I think about Pulmonx based on what we read today. Assessment: Pulmonx is at a very interesting place right now. On one hand, they are growing sales, they've secured cash for the next 12 months, but on the other hand, they have been losing money. They are dependent on a single product and they face competition from bigger companies with more resources. The single biggest risk is adoption. It's a procedure. It has to be taught. Doctors need to get on board. Also, reimbursement from insurance companies could make or break them. My conclusion is that Pulmonx has a lot of potential, but also a lot of risks. It's definitely not a safe investment. You need to decide whether you believe in their technology and their ability to execute their plan. Alright, that's our breakdown of Pulmonx's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description if you want to talk about this with other investing nerds. Thanks for watching. See you next time.